Deliveroo stock in the UK London Stock Exchange. It's official, Deliveroo have done their IPO on the 31st of March 2021. Their initial public offering is more or less a launch process any private company needs to do in order to become public and have its shares traded in the stock market. So as we speak now, guys, you can buy shares in Deliveroo stock in the London Stock Exchange. We definitely have to talk about this one because the main thing investors will want to know now is, should you invest in Deliveroo stock or not? But first, if you like the sound of this or you're a fan of the channel, then could you do me a small favor, guys? And that's to like this video, share it too, and subscribe with the notification bell on as well. Cheers, guys. So to answer the question, is Deliveroo stock with the ticker symbol ROO.L in the London Stock Exchange worth investing in? The blunt and honest answer is no. And if you guys would have asked me this question before they became public, my answer would have been the same. It would have been no. Because one thing you guys should know about my channel is that I do not like investing in stocks just because of the hype around it. No, that's not what my channel is about. I like to teach people to think for themselves, and this is a big reason why I was suggesting not investing in Deliveroo straight away, just because it tends to never end well investing in a stock that's just become public. It's kind of like when you're a kid, you know, and you see them latest, freshest, newest trainers or whatever it is on the market. And so eventually you decide to get it, and then you realize, actually, hold up here, I actually got ripped off. It's not nearly as good as what I thought it was. The exact same thing happens whenever it comes to a new stock being introduced into any stock market. It's the exact same process. Deliveroo is no exception. As an investor, especially a long-term to medium-term investor, which is what I teach about on my channel, you need much more substance than that to validate you investing your hard-earned money into a stock like that. Apparently their IPO was a big flop as well, and I'm not surprised. Just look at their financials. Yeah, it's all well and good. Their revenue has been increasing throughout the years. But if you look down below, so have their operating costs too. And even more so, guys. This is why I always tell you, it's not about how much money you make. It's about how much money you get to keep. That's the most important determining factor here. And Deliveroo, the money that they get to keep, i.e. in their net income, is not good at all, guys. They're actually getting more and more negative. So they're making more and more of a loss compared to previous years. This is a big concern. Flicking over to a balance sheet, it does seem reasonably okay, because when you do look at the current assets and you compare it to the current liabilities, it's able to comfortably cover it, guys. However, when you focus on the non-current aspects, you know, by looking at the difference between the total values and their current counterparts, that gives you the long-term counterparts. You will notice that it's not a good story that's being told there. You see, when you look at the long-term assets, which is basically the difference between the total assets minus the current assets, it gives you a figure of roughly £128.9 million. But when you consider that 41.9 million of this comes from goodwill and intangible assets, which is basically nonsense and allows us to stop the opportunity to fudge the numbers, you realize that the actual true long-term assets is £87 million instead. And when you compare this to the long-term liabilities, which is similarly the difference between the total liabilities minus the current liabilities, and equates to roughly £141 million, you're going to notice here that you're going to struggle to cover that liability. Now granted, they still got excess current assets to make up for this difference, but what I can confidently say is that I've seen much better balance sheets than this, guys. Moving over to the cash flow statement. And as you can see, for the cash from operating activities, it has not been good, guys. It's only last year that it started to be positive. This is a big concern. The cash from investment activities being negative shows that Deliveroo stock is still at its early stages and they're looking to expand further. However, the cash from financing activities being positive shows that Deliveroo is looking to borrow more and more money, guys, from their debtors, as opposed to having the money themselves to pay for things. This could be a telling sign of what's to come in the future as they borrow more money. Overall, I believe Deliveroo is looking to go through a mega growth phase. There are just very clear signs telling me this. The fact that the revenues have consistently grown throughout the years, they're putting a lot of money in their cash from investment activities to expand further. But ultimately, the most telling sign is that they've become public. The number one reason why companies tend to become public is because they're looking to raise more capital in the hope of expanding further. All of these things put together just make me think of how big Deliveroo can be in the future. However, and this is a big however, they've got a lot of work to do in their income statement. They need to focus on keeping their operating costs down low in order to maximize their profits, because they've taken some really huge hits over the last several years. And it's for these reasons that Deliveroo stock would not be investment for me now. But that's just my thoughts. Let me know what you guys think about the newest stock in the London Stock Exchange. And don't forget to show me some support, guys, by liking this video, sharing it too, and subscribing with the notification bell on as well. It's your favorite YouTuber, DSN Finance, sharing my thoughts and my experiences with you guys every Sunday at 3 PM. Have a great day, people. Bye.